Back in the good old days of 10 years ago, if you wanted to rob a bank, you needed a gun, a vehicle, and a getaway plan. But now, all you need is people's data or someone's face and a way to launder the money that the vendor just hands over to you. So today, we're going to talk about online loan fraud. Let's start with an obvious statement. Lending money is inherently a risky business, and it gets even riskier when fraudsters come to play. There are a few types of online loan fraud, including but not exclusive to mortgage fraud, payday fraud, and loan scams. But the outcome is always the same. The vendor pays out, and the criminal just disappears with the cash. It's the type of crime on the rise. And one of the reasons could be because banking and lending has moved online, and vendors try to make processes as frictionless as possible. In many cases, it is the applicant who has bad intentions. They use stolen or synthetic IDs. Stolen is pretty self-explanatory. These are either real people's identifications they have stolen or bought online. Synthetic is slightly weirder, with them piecing together a real-looking ID from different elements found online. According to the Federal Reserve, synthetic IDs are getting so good that up to 95% of them bypass fraud checks. There is also a volume game fraudsters can play, where they use bots or money mules to make multiple online loan applications, overwhelming the vendor systems and hoping that a few get through. And they do. Here's the thing. Many loan companies lack the data to make good decisions and to run proper risk profiles, but this is seldom their fault. The first reason is that loan companies operating in developing countries have very high numbers of underbanked or unbanked people. So that means no credit history and no paper trail. But it's not all in the developing world. People in first world countries also suffer from a lack of credit history. In the US, for example, there are over 45 million people with limited or no financial records. It's a chicken and egg situation. They can't build their credit score because they cannot secure loans, and they cannot secure loans to build their credit score. This creates optimal conditions for fraudsters. They see that loan companies have to make fast decisions and that they may not have complete profiles for checks on people. So the criminals figured out how to give just enough information to seem legitimate. So if you're an online lender, how do you limit opportunities to be defrauded? Well, a huge way to do this is to look beyond traditional banking and financial records for applicants. Combine old school methods with new techniques like social footprinting and checking email, IP addresses, and phone numbers for useful data points. This is good because whereas banking records can become stale, this digital footprint is real time and immediate. So they don't need to physically enter your business to stroll away with a digital bag of loot. So it pays to know as much as possible from multiple sources about loan applicants before you decide whether to give them your cash.